Most traders do one thing that silently kills every big trade they will ever have. They get out too early, they see profit, they feel relief, and they leave the best part of the move sitting on the table while the stock keeps going without them. Jesse Livermore cracked the code on this over 100 years ago. He called it the secret that separates the traders who survive from the traders who actually get rich. And today, he's going to teach it to you himself. Let's get into the video. Enjoy.
There is a moment in every great trade where most people do the same thing. They get out. The position is working, the profit is real, they can see it right there on the tape, growing, confirming everything they believed when they entered. And instead of letting it breathe, instead of allowing what they got right to pay them everything it was built to pay, they take it, they close it, they walk away satisfied with a fraction of what the trade was offering. And then they watch. They watch the stock continue in the exact direction they called. They watch it move another 30%, another 50, another 100. They watch the trade they closed at a small gain become the trade that could have changed their life. And the worst part, the part that nobody talks about, is that they made all the right decisions to get into that trade. Their analysis was correct, their timing was right, the tape confirmed everything. They were right about the most important thing, and still walked away with almost nothing to show for it. That is not bad luck. That is a system problem. And it is the single most common way talented traders stay poor their entire careers. I know because I did it, more times than I want to admit. In the early years, I had a gift for reading the tape that most men would have traded half their intelligence to possess. I could feel a move building before it arrived. I could sense the difference between real strength and manufactured strength, between a move that had legs and one that was going to reverse the moment the weak hands got excited and piled in. I was right more often than I had any right to be, and I was still broke, repeatedly, embarrassingly, broke in ways that should not have been possible given how often I was right about the direction of a stock. The reason took me years to understand, and when I finally understood it, it changed everything. I was managing my winners the same way I managed my losers. I was treating profit like a problem to be solved instead of a position to be maximized. I was exiting when I felt good instead of when the market told me to. And in doing that, I was cutting off the exact trades that should have built my fortune and replacing them with a long string of small wins that never compounded into anything real. The market does not pay you for being right. Let me say that again because it is the most important sentence I will ever speak to you. The market does not pay you for being right. It pays you for being right and staying right, for having the patience to hold a correct position while every bone in your body screams at you to take the profit and feel safe. Safety is the enemy of wealth, not risk, safety. Because the moment you prioritize safety over process, you start making decisions based on how you feel instead of what the tape is showing you. And feelings are the most expensive thing you can bring to a trading desk. Let me tell you about Anaconda Copper. It was 1906. I was 28 years old. I had already been broke twice, and I had spent years developing what I believed was a genuine understanding of how large moves worked. Not the small daily fluctuations that kept the gamblers busy, the big moves. The ones that took months to build and weeks to deliver and paid the patient trader huge. I had been watching Anaconda for weeks. The tape was showing me something I had learned to recognize: accumulation, the quiet, invisible process by which the strong hands, the operators, the men with real capital and real information, loaded their positions before a move. Most traders could not see it. It did not announce itself. It showed up in small ways: volume patterns that did not match the price movement, reactions that were shallower than they should have been given the selling pressure. The tape was whispering that someone important was buying every dip with patience and conviction. I entered, small at first. That was always my method. Not because I lacked conviction, but because the market had taught me, painfully, that conviction without confirmation is just arrogance wearing a different coat. I entered small, and I watched. The stock moved in my direction, not explosively, not in a way that attracted attention. Steadily, quietly, the way a large ship begins to move, almost imperceptibly at first, and then with a momentum that becomes impossible to stop. And here is where the old Jesse, the broke and desperate Jesse, would have taken his profit and felt clever. I did not take it. I added to the position. This is what I want to teach you today. This is the thing that most traders do completely backwards. They add to losing positions because hope is cheaper than discipline, and they take profits from winning positions because fear is louder than process. They do the exact opposite of what the market is trying to tell them. They fight the current instead of swimming with it. Adding to a winning position is called pyramiding. And I do not mean averaging up carelessly. I do not mean doubling your size every time a stock moves a few points. That is not a strategy, that is gambling with extra steps. I mean something very specific, something that took me years to develop and more losses than I care to count to get right. You add to a position only when the market proves you correct, not when you feel correct. Not when your analysis says you should be correct. When the price action, the tape, the actual movement of the stock in the real world proves that the thesis you entered on is alive and advancing. Here is how I thought about it. Every trade I entered was a hypothesis. The tape was the experiment. If the experiment confirmed the hypothesis, if the stock moved in my direction, held its gains, refused to give back more than a fraction on reactions, then the hypothesis was worth more capital. If the experiment contradicted the hypothesis, if the stock stalled, reversed, failed to advance on what should have been good news, then the hypothesis was wrong, and no amount of hope or patience or averaging down would change that. Most traders do the opposite. They enter with conviction. The stock moves against them. And instead of questioning the hypothesis, they double down on it. They tell themselves the market is wrong. They average down. They turn a trading position into an investment. They turn a disciplined loss into a catastrophic one. And when it finally breaks them, they tell everyone the market is rigged. The market is not rigged. The market is honest in a way that human beings almost never are. It shows you, in real time, whether your judgment is correct. Most people just refuse to look. When Anaconda continued to advance after my initial position, I added, not all at once, in stages. Each addition was smaller than the one before it, and I want you to understand why, because this is the technical heart of everything I am teaching you. When you pyramid correctly, your largest position is at your lowest average cost. Your first entry, when the risk is highest and the confirmation is lowest, carries the most shares. Each subsequent addition carries fewer shares because the price is higher, the average cost is rising, and you are paying for confirmation with slightly reduced upside. What you are buying with each addition is not more profit potential. You are buying certainty. You are paying the market a small premium to confirm that you are still right. By the time the position is fully built, you are in a situation that most traders never experience. You have a large position in a stock that the market has repeatedly confirmed is moving in your direction. Your average cost is well below the current price. You have what I called a cushion, a buffer of unrealized profit that protects you from the inevitable short-term reactions that shake out everyone who entered late and has no margin for error. That cushion is everything. It is the difference between holding a winning trade through turbulence and being stopped out of it at the worst possible moment. Let me tell you what most people do with unrealized profit. They worry about it. They watch it go up and feel good. Then it pulls back 3% on a normal reaction and they feel sick. They feel like they are losing something they already had. And because they feel like they are losing it, they act like they are losing it. They exit. They take what they have. They tell themselves they made money, which is true, and ignore the fact that they left the majority of the move behind, which is also true. This is the psychology that keeps most traders poor no matter how many years they spend at this. It is not a knowledge problem. You can explain pyramiding to a trader in 20 minutes and they will understand it intellectually and still be unable to execute it emotionally. Because execution is not an intellectual exercise, it is a psychological one. When I held Anaconda, there were days the stock pulled back. There were days the tape got noisy and the men around me started doubting the move. There were moments when the paper profit on my position shrank enough to make a lesser man scramble for the exit, and every single one of those moments was a test, not of my analysis, of me, of whether I had the discipline to stay with what I knew to be true while the market temporarily suggested otherwise. I held. And when Anaconda finally delivered, it delivered not a small win that would have covered a few weeks of expenses. It delivered a position-building move that fundamentally changed the trajectory of my capital. That is what a correctly held winning trade does. It does not just make you money, it advances you, it takes you from one level to another. It compounds in ways that 100 small wins can never match because 100 small wins teach you to think small. One great trade held correctly teaches you to think in terms of what the market is actually capable of paying. Let me tell you about the concept I called the pivotal point, because pyramiding does not happen in a vacuum. It happens at specific moments in a stock's movement, and those moments are rare, and learning to see them is the difference between a trader who survives and a trader who thrives. A pivotal point is the moment where the market resolves a period of uncertainty in a decisive way. It is the breakout from a long consolidation. It is the recovery from a sharp reaction that held at exactly the right level. It is the moment the tape stops asking questions and starts giving answers. And the answer it gives is directional, unmistakable, actionable. I did not buy at random. I did not enter because a stock looked cheap or because I had a feeling. I waited for the pivotal point. Sometimes I waited months. Sometimes the pivotal point never came for a stock I had been watching, and I moved on to another. Because patience is not just a virtue in this business, it is the actual mechanism by which you protect capital until the moment arrives when deploying it makes mathematical sense. After the 1907 crisis, after the cotton disaster with Percy Thomas that took back most of what I had made, I spent 2 years rebuilding my approach from the ground up, not just my rules, my psychology, because I had come to understand something that nobody had ever told me and that I had never read in any book. The system is not the hard part. The system is actually the easy part. You can write the rules in an afternoon, cut losses quickly, let winners run. Trade only in the direction of the trend. Add to winners, never to losers. Wait for the pivotal point before entering. These rules are not complicated. I could teach them to a moderately intelligent person in an hour. But knowing the rules and following the rules are two completely different skills. And the gap between them is where almost every trader's career ends. I watched men who understood the theory of trading better than almost anyone fail consistently because they could not bridge that gap. They knew what to do. They just could not do it when the pressure was real and the money was on the line and their emotions were telling them a story that contradicted everything they intellectually believed. The gap is closed not through more knowledge, it is closed through experience. Through sitting inside a trade that is working and feeling every urge to close it and choosing deliberately to stay. Through doing that once, then again, then enough times that the staying becomes more natural than the exiting. Through building, trade by trade, a track record of executed discipline that your own mind can look back on and trust. That is what I call the education no course can give you. You cannot read your way to it. You cannot watch videos about it. You have to live it. You have to sit in the discomfort of an open winning position and do nothing, and feel what that costs you emotionally, and choose to stay anyway. Every time you do, you build something. Not profit, not yet. You build the capacity to hold, and that capacity, that ability to stay with a winning position past the point where your fear wants you to exit, is the most valuable skill a trader can possess. It is rarer than the ability to read a chart. It is rarer than the ability to time an entry. Most traders who have been doing this for 20 years have never fully developed it. Because it hurts. Letting a winning trade breathe hurts in a way that is deeply counterintuitive. The pullbacks feel like losses even when you are still in profit. The sideways periods feel like the trade is dying. Every day it does not advance is a day you wonder if you should have taken what the market gave you earlier. And that wondering is the voice of fear. And fear in this business costs you more than any bad trade ever will. I want to tell you about 1929 again, not the shorting. You have heard enough about the shorting. I want to tell you about the months before the crash when I was building my short position, because those months illustrate everything I have been teaching you about pyramiding in a context most people have never considered. I did not short the market all at once in October. I began shorting in the summer, small positions, testing, watching how the tape responded to my entries, watching how the market absorbed selling pressure, watching whether the reactions I expected from a market beginning to top were actually materializing in the price action. They were, slowly at first, then more clearly. And each time the tape confirmed my thesis, each time I saw the signs of distribution replacing the signs of accumulation, each time a rally failed to reach the previous high, each time volume expanded on down days and contracted on up days, I added to the short position. This took months. There were weeks when the market rallied sharply and my short position showed losses that would have terrified a less disciplined trader. The newspapers were still bullish. The public was still buying. The men around me thought I was wrong. And there were moments, if I am being honest with you, where I wondered if I was wrong. But the tape said otherwise, and I had learned, through everything the market had taken from me over 30 years, to trust the tape over the voices, including my own. By the time October arrived, I had a pyramid of short positions built over months of patient, confirmed accumulation on the downside. The average cost of my position was well above the market's eventual bottom. I had a cushion, I had room, and when the crash came, I was not just positioned correctly, I was positioned massively. Because I had added to the position every time the market proved me right instead of taking profit the first time it moved my way. That is how $100 million trade is built, not in a day, not through a single brilliant insight, through months of patience and discipline, and adding when the tape confirmed, and holding when the fear spoke, and trusting a system that had been earned through decades of costly experience. Most traders will never build a trade like that. Not because they lack the intelligence, not because they cannot see the opportunity, because they cannot hold, they cannot stay. They cannot resist the voice that says, take it now, take it before it disappears, take the small win and feel safe. And the market, which is completely indifferent to your emotional comfort, will continue to advance without them and pay the full amount to the very small number of traders who learn to stay. Here is what I want you to take from everything I have said today, not as a list, not as rules to post on a sticky note, as an understanding, a real felt understanding of why this matters. You are not going to build wealth in this market by being right. Being right is the beginning, it is the entry ticket. After you are right, the real work starts. After you are right, you have to stay right. You have to manage that position not with your emotions, but with the tape. You have to add when the market confirms, and hold when the market tests, and exit only when the market. Not your fear, not your profit target, not a number you wrote down before you entered, tells you the move is done. The market tells you when it is done, not always clearly, not always without ambiguity. But if you are watching closely enough, if you have spent enough time learning to read what the tape is actually saying instead of what you want it to say, you will feel the moment when the weight of evidence shifts, when the reactions start deepening, when the rallies lose their conviction, when the price that used to bounce sharply off support starts lingering there. That is the market speaking. That is the tape telling you the move has given what it had. That is when you exit, not before. Not because a number looks good or because you have been in the trade for a certain number of days or because someone told you to take profits after a 20% move, because the market told you the move was over. Until that moment, your job is not to manage the profit. Your job is to let the profit manage itself. Your job is to protect the position from your own impatience, to be the last thing standing between your winning trade and your emotional need to convert it from potential into certainty. That is the hardest job in trading. And it is the only job that pays at the level that changes your financial life. I spent 40 years learning this. I spent 4 fortunes and 1 lifetime. I made it and lost it and made it again and lost it again because I kept forgetting, in the moments when emotion was loudest, what experience had already taught me. Do not make my mistake. Do not wait until your fourth bankruptcy to understand what your first win was trying to show you. The tape is telling you something right now, not about the market, about yourself, about whether you can stay in what is working long enough for it to pay you what it was built to pay. The question has never been whether the opportunity is there. The opportunity is always there. The question is whether you are the kind of trader who can hold it. If something in this reached you, if it made you look at an open trade differently, or think about the last winner you exited too early, share this with a trader who needs to hear it. The market keeps score without sentiment. So should you. What I just taught you is only one piece of what this game demands, and there is much more to say. The tape is always talking. The only question is whether you are listening.
That right there is 100 years of hard earned wisdom compressed into one video from a master trader. Livermore paid for those lessons with 4 fortunes. You just got them for free. Selling too early is a common mistake we all make. What is one time you waited and it paid off for you? Share it in the comments below, and until next time, have a great trading day.